So Blake, where do we choose to invest and why?
So we've been very particular in the markets that we select. And long story short, we've selected Arizona and Texas. And that's because they're landlord friendly and the natural disasters that occur there are within a level of risk that we're comfortable with. And from an insurance cost standpoint and just operationally, operating a team, running the communities there, we found it to be the best.
And so so you talk about Arizona and Texas. Why do we choose to buy strategically in these specific submarkets or these metropolitan areas? And why don't we do maybe a scattershot approach where, buying deals all over the country?
So we have a lot of brokers that have asked us that question. And the long story short is it's much more efficient to operate a portfolio in a given area, call it like a Phoenix metropolitan area, because you can hire a staff and each staff member or a team member can be specific to a really good strength and role. And so you can create a collaborative team and execute at a way higher level than trying to hire one manager out in a bunch of different locations. And it takes vendors, it takes plumbers, electricians, home set guys, home manufacturers need to have plants in the surrounding area. So the further out you go with all your properties into randomized locations, the more difficult it becomes to effectively and efficiently manage those costs.
It's a great point. And managing from an efficiency standpoint is one thing, but then also when you think about what is the long-term exit plan, and by focusing and being specialized in these specific growing markets, such as a Dallas or a Phoenix, what you do is you provide scale. So when we go to eventually maybe exit one of these deals, you're not selling a one-off deal out in the middle of nowhere. What you're doing is you're providing hundreds of different space count communities to, say, an institutional partner that is looking to deploy, millions, if not billions of dollars into this space. And what that does is it provides what's called cap rate compression because of being able to deliver a portfolio is much more accretive or valuable than a one-off approach to selling one deal.
Totally. And that really becomes more and more valuable the larger the community portfolio becomes. And that really goes back to the institutions and the pension funds and the investors that these institutional players want such large dollar allocation into manufactured housing that the larger and the cleaner, the portfolio needs to be clean and on scale. The bigger the scale, the more valuable that whole portfolio becomes, which is pretty amazing on returns. We have a lot of people that come to us that have owned rentals, either have in the past or continue to own and operate just single family homes as rental properties. And what is really interesting is as we start having those conversations, they're looking for a way to really collect that passive monthly revenue from a really good residential, being that it's a rental property that people live at versus a commercial property, an office building, a commercial industrial warehouse. That's a very different profession. Most people are more comfortable with housing. And so we provide the service where we have a fully integrated management company to manage these mobile home parks and manufactured home communities. And essentially how it works is you have, let's just say 100 unit mobile home park. You have a 10 acre piece of property. And on that 10 acres is 100 mobile homes, different ages potentially. We'd like to buy the newer builds, the better. And so there's 100 mobile homes paying lot rent. So we don't own the mobile homes typically, but we are fully integrated as a manufactured home dealer so that if there are homes that leave, we can go ahead and pull homes that are older and no longer, highest and best use for that space and put in a new mobile home and then sell it. And the goal being to operate a mobile home park that is fully occupied by people that own their mobile homes or manufactured houses, and they pay a space rent. And that is so that you can reduce your overhead expenses on repairs and maintenance, fixing toilets, any of the normal interior repairs when like in apartments, when units turn over, you have to fix the walls, patch, paint, do the carpets, put in some new, vinyl plank, whatever it is. We don't have to do that once we have all the homes sold. So then our expense ratio is significantly reduced compared to multifamily or apartments. And so then the turnover on units is significantly reduced as well, because people own a home and can be an asset. In a lot of the cases, these communities we buy, the home values go up for the residents that own their homes. And so if they're going to leave and move on, whether they have to move and relocate for job purposes, or they just want to go to a different place or live in a different housing situation, then they can sell their house. Well, we collect space rent while they're selling their house, and then we collect space rent for the new incoming person that buys it. So we don't have the same turnover effect. And so on a stabilized mobile home park, typically it's under 5% per year. And so we have a more consistent income stream percentage-wise on collections, and it creates a very stabilized cash flow scenario.
Let's talk about deal structure. So we are a deal-by-deal single LLC syndication model. Why do we focus on doing deal-by-deal single asset syndications versus doing a fund structure?
So it's been a challenge to find a lot of deals at the same time. And so in a way, I'm really happy that we ended up there, because the institutions are having a hard time, like whether that be the pension funds or you name it, they can't put enough money into the space at a single given time or a single year. And so that's been the case where like we have deals that we're chasing, but we only end up winning on a bid or finding off market one or two here and there. And so it really has become a focused effort now. And then we have investors that have different needs, with whether they're looking for the depreciation from the asset or they're just looking for the returns, but it really keeps it nice and clean and separate. And so we haven't decided to go in the fund direction, just in the stance that there isn't enough deal flow to really deploy the capital in a hurry.
And not only deal flow, there's not enough good deals. And so we don't want to be forced buyers by raising excess capital and then having to place that capital in deals that maybe we otherwise wouldn't if we didn't feel needed or forced to. Now let's talk about why the single asset structure is so advantageous from a tax structure. And it goes through a little bit of what we believe in as cash flow investors. And so when we buy a deal, we generally will hold that deal between 6 to 8 years. And it generally takes about that time to stabilize an asset where you could really go in and do all the improvements and uplift the community and then drive that value through net operating income. However, when you go to sell that asset, it allows for something very interesting, which is the 1031 exchange. And so on all of our assets, when we do sell them, we 1031 exchange, roll all of our investors, including our profit, into the upleg of the next deal, which compounds cash on cash and is tax deferred, allowing us to use pre-tax dollars to then continue to grow our investors' capital and compound the cash on cash that we then receive every month, whether it's our investors or us included.
And that's a great point, which is why do we consistently co-invest from the 1031? Whenever we sell a community, we never pull our sweat equity. We always continue to reinvest those proceeds and retain that alignment with our investors, because we really are here for the cash flow and the passive cash flow and the tax treatment that comes with the passive nature of the income that's produced monthly and through cash flow. And so we are 100% committed to the monthly cash flow model, even ourselves.
Yeah. And we believe in these deals wholeheartedly, to the extent that we want to own these assets into the future and even generationally hand them off to heirs as well, because we believe so much in the benefit and the value that manufactured housing investment provides.
All right. If you're enjoying this content, hit the subscribe button and turn on notifications, and check out the description below for our websites listed. Thanks a lot for joining.